All right, so we'll start. This is Hammad Khan here, and today we have the pleasure of having Sarmayacar with us, two people from there, Rabeel Warraich and Salman Chattha. What I'll do is I'll just hand over to either of them who will present a slide deck, and what we will try to do is have question and answers either during it or towards the end of it, mostly to make it more interactive. So if you have questions, please post it. Because only I will be able to ask them, otherwise it becomes very difficult. What I will do is, if there are too many questions, we will go through just common questions around them. So if your question gets missed or something, please, I apologize for that in advance. I also have to interact with the speakers in a little bit of a manner and ask them questions, so we'll keep it that format. So over to you, Rabeel or Salman, whoever is presenting the slides, please go ahead.
Perfect.
Great.
So I'll start off. Just to confirm, can you guys see my screen right now? With this slide deck?
Yep, everything is visible.
Okay, awesome. So pleasure to be here, and I'm glad to see a reasonable amount of interest in this as well. So what we want to do in this session with everyone here is to give a small introduction of both myself and Rabeel, share an intro on what Sarmayacar has been doing, and also give you a little bit of color on what's happening in the Pakistan ecosystem. So before I get going, myself, I lead the investment function at Sarmayacar, but also very much involved post-investment with our portfolio companies. Rabeel, of course, is also here with us, and you'll get to hear from him a lot soon, a lot more. He's the founder of Sarmayacar. Prior to launching and founding Sarmayacar, he was based out of London, where he has nearly a decade of experience working primarily in banking roles at GIC and Morgan Stanley. So Rabeel, of course, is one of the big reasons why I decided to leave Canada, where I was also working in the investment banking practice, and moved to Pakistan. So the case that we've, of course, have at Sarmayacar is very much a Pakistan-focused investment firm where we're looking at early stage seed and Series A opportunities. So what makes Pakistan exciting? I think most of the audience here is pretty familiar with what the macro situation looks like. We have over 200 million population, that is a majority population which is under the age of 30. And a significant size of it also happens to be living in urban centers. We think that this, one of the largest middle classes in the world, is now ready to adopt some of those technological revolutions that have captivated the West, and of course are starting to also come towards East in terms of China, India, and so on. On a macro level, what's exciting about Pakistan is also increasing stability. On a broad basis, we are seeing political stability come through. We're seeing terrorist incidents also to be somewhat more under control. And of course, the macro bet is that inshallah, the sentiment continues to improve and it makes it easier for investors to invest in this ecosystem. The sentiment has also resulted in a lot of diaspora Pakistanis with extremely credible experience coming back home. And we think increasingly there is more interest from both diaspora Pakistanis to invest in Pakistan, including foreign outside capital looking into avenues to invest in Pakistan. From a tech perspective, when we speak of digital footprint, what excites us is a large mass of Pakistanis today have both a cell phone and increasingly higher penetration rate of smartphones. Nearly 1 million smartphone connections are coming on board each month, and that rate is only accelerating. Furthermore, we're also seeing consumer spending levels increase over the last 5 to 10 years, and as expected, this will result in a larger mass market audience that can be captured via the tech revolution that we, inshallah, think will come about. From just a broad comparison perspective, we look at Pakistan and we're starting to see a lot of similarities when we think of Indonesia, India, and I guess to some extent, even though they're far more advanced than perhaps Pakistan, China. But this is, in our view, the natural transition that Pakistan will also see. Today, nearly $250 billion worth of consumer spending happens in Pakistan. This consumer spending primarily occurs through offline channels. We think the mass market with high amount of smartphones, with internet rates that are cheaper than most parts of the world, are ready to adopt and move towards technological means of consuming goods and services. That, of course, in our view, will culminate into the emergence of unicorns in Pakistan. Excitingly, we have seen unicorns being built by Pakistanis. Kareem has been built by Pakistani. We see Zameen today being built by a Pakistani. The talent is there, but these companies still do not serve just Pakistan alone. We think over the next 5 to 10 years, this transition will occur where you will see Pakistani entrepreneurs building ventures that will be unicorns serving the Pakistani market alone. From the last perspective that I want to touch upon is the greater ecosystem that's building around both the venture space and the technology space. We're seeing both larger amounts of capital coming into Pakistan from abroad. Furthermore, we're also seeing excitement in terms of the micro level where month-over-month traction at these tech businesses is becoming exciting, which is, of course, attracting a lot of foreign capital. With that, we're also seeing talent come back to Pakistan. So we're seeing more entrepreneurs with credible experiences based out of the US or based out of Europe coming and looking at avenues where they can make businesses that are leveraging technology at their core and really capturing the mass market audiences to build businesses of the future. So we've seen already over the last 18 months significant traction when it comes to several multi-million-dollar rounds emerging in the Pakistan ecosystem, and we're reasonably confident that this trend will only continue and will accelerate over the next few years. Giving you guys a little bit of color on what the Pakistan story is and what the investment thesis is, I'll pause here and I'll give it off to Rabeel to share a lot more about the journey that he's had in launching Sarmayacar, and subsequently also share how we are investing in the Pakistan ecosystem and some of the investments we've made already.
Thank you, Salman. I'll need you to continue to navigate the deck if you don't mind. But just picking up where Salman left, in 2016 is when Sarmayacar in its original shape came together. At that time, I was working as an investment professional with the Singapore government sovereign wealth fund. And effectively, everything that I know about investing or being an investment professional, I learned at that place. And the first foray was actually into earlier stage businesses which were originating out of Pakistan. And at that time, we were setting up small holdcos where syndicates of individual investors would come together and we would take a stake in the underlying company in Pakistan. Our first investment was Qatari, which was the last day of 2016. And that then prompted a couple of additional investments shortly thereafter, which were again structured in a similar way, which was a combination of individuals coming into one common holdco, and then that holdco would acquire a stake in the underlying company in Pakistan. There were many learnings when that started. First was that if you wave any sort of cash in Pakistan, generating deal flow is not really a problem. However, what we realized was that the overall opportunity and the approach one needs to take to have a diversified fund actually would require more than what my own pocket would allow, or even the immediate pockets of the people that I was initially investing with. And so that required both an institutional setup and approach to be taken for the country. And the second key learning was that this could not be done remotely. I was still in London at that point and started Sarmayacar with the view that in a few years' time, I might see how this goes and whether that creates enough of an opportunity in Pakistan for me to move back. the learning was very quickly that unless that was really the basis on which this was started, it will be very difficult to both pull together a fund and also continue to back these businesses, which we realized did not just need solving for one round of capital. Just like venture building, has many different stages, venture financing is also really a continuum of financing stages. And we need to both look at what has happened before and our own participation, but also try to help these companies moving forward. So what that meant was overall, there was a lot more hand-holding that was required for these businesses and earlier stage entrepreneurs that had not been exposed to the kind of investment world that I myself or Salman or many of the people that are on this call might have been exposed to. And so that prompted in early 2017 a serious consideration to actually leave what I was doing in London and move back, because that would be the only way that I would be able to really raise a fund and bring together the infrastructure that we believe is required on the ground and for this to become like a long-standing and viable operation. So in mid-2017, I left my role in London and started raising, technically from November 2017, a formalized GPLP fund. And again, the idea was to try to set up some sort of this bridge building mechanism which allowed people to both invest potentially in the country, but also participate and provide any sort of value add that they could. Because the gap that was there in Pakistan was really people who had done it before, people who had raised capital from investors who had then used that capital to show progress for their underlying businesses, then gone to the market again to raise more and gone through that cycle. And the challenge that we faced at that time, and still do to an extent, but there's has been great improvement on that front, has been really how do you bridge some of that knowledge gap, some of those expertise gap. And absent a formal fund or a formally set up structure that would facilitate something like this, while looking out for all the key consideration one has to look out for in Pakistan, i.e. be with feet on the ground and with multiple eyes and hands, it was not really feasible to do that all in that syndicate structure, because again, it was not formalized. It did not allow for a team to be put together which can both review opportunities, but also after investment, continue to monitor them and provide value add, which we consider to be a very, very key aspect of what we're trying to do with Sarmayacar. So in November 2017, started raising this fund. I realized very quickly that for anyone who wasn't Pakistani, one of the best ways to convince them about Pakistan was to actually bring them to the country. That really highlighted this perception reality gap that existed with a lot of people. But when when some of those people who belong to the investment sphere, when they would look at what are the next growth opportunities or potentially the higher yielding opportunities around the world, Pakistan started standing out a little bit because, again, because of its population, the demographic, the growth opportunity that was there. And when comparing to like negative yields in Europe and many other more developed parts of the world, it became something which could be, again, high risk, but also with this potential of generating high return. And so we started in November 2017, had a first close of our fund in November 2018, when we had, at that time, the base level that we thought would be required to both, again, set up that infrastructure that I referred to before, but also be able to have a conviction deployment model which would allow us to increase exposure to select companies that are performing within the portfolio. And the idea was to play not only in the Series Seed stage, but also at least one further round, so that we can provide that hand-holding up to a stage when some of the larger, more global and internationally focused funds could also start participating in the market and have this comfort and knowledge that there is a locally set up, locally based fund with the team on the ground that is doing the work and actually doing the more regular hand-holding for the entrepreneurs. And they could then participate at a slightly more de-risked stage. But of course, when it also makes sense for a fund like ours to have a deeper pocketed investors be involved with those companies. So that was, again, the genesis of the setup. We were throughout this period investing in parallel. every single company that we invested in, even as individual syndicates, was contributed to the fund. Again, at cost, the idea was to try to set up as blue chip and as clean a structure as possible, what we had learned in the investment world, and then try to find different spaces in the country which would have, like, an attractive enough market, not necessarily now, but in a few years' time, and backing the teams that we thought would be the best place to tackle those spaces. And within that journey, of course, there's now 7 portfolio companies that we have, and we have participated in four of them, and also follow-on rounds that have already happened. And the idea is that we will continue to, inshallah, invest this fund in about 14, 15 companies at most, and playing again across this Series C, Series A stages primarily. However, one key responsibility that we've had is really seeing some of these companies also through the these various stages of venture financing, and to try to make it easier for them to raise that follow-on financing, which entails having introductions to the kind of investors which were previously not really looking at Pakistan, helping them with hiring, helping them with actual strategic decisions around particular spaces or areas where they could expand into, or even geographically where it might make sense for them to explore other segments of the market that might not yet be explored, but make for a natural transition. So all of this started coming together in the form of this team and the infrastructure that we were able to set up. And now we have, again, a very structured approach to not only deal selection and deal execution. And we have various different streams on which we conduct our diligence, from commercial, financial, technical, with formal reports that are generated, and which then is taken to a formal investment committee, which again, in the last year, in fact, we've had more no's than yeses. So there is quite a bit of discipline and rigor that is being applied even before an investment is made. And then once an investment is made, there is actually quite a structured approach tailored for each company to identify areas where there could be additional value creation that could be facilitated by us, or even in areas where there could be some external support that we can then leverage the broader Sarmayacar platform for, or to try to use our portfolio to realize synergies, or even to bring as a platform individuals with the kind of expertise that might be able to either help some of the entrepreneurs, or even potentially join the company, one of the portfolio companies directly. And the idea here is, again, that we're very early as an ecosystem in the development and progress of some of these businesses. But the view we had to take from the beginning, and one that we very strongly subscribe to still, is that even if we wanted to, just one company or one fund or one individual cannot be successful in this ecosystem, because we need a lot of things to be coming together, and a lot of those things to be moving forward concurrently, which means that actually the opportunity to generate a return is much greater than what even our own investments might entail, or any one individual funds. And that's because when an ecosystem is at the kind of stage where Pakistan is, you need more and more investors to participate. And even if they're not necessarily resulting in investments coming directly to your companies, it does mean that there's more eyeballs that are coming, falling on the market. There's more investors that are getting comfortable with the Pakistan risk. And at the right stage, those investors might also participate in one of our companies. And I think the idea was really to lay some of the building blocks at that initial stage, so that we could show that both a blue chip fund of this structure and nature can be set up and raised for Pakistan, and that the underlying companies that have been working very hard to show that traction are then also getting that funding from players like ourselves. Overall, if I just take a little bit of a step back, it's just one comparison that I want to share, which is, again, versus India, which is not a very relevant example in a lot of cases. But to the extent that we talk about these ventures being primarily driven by underlying consumer behavior in markets like Pakistan or India. If you if you have the Pakistan-India border, last year in India, there was $14.5 billion of venture financing. Compared to India, we are 1/6 the population, roughly 1/10 the economy, but the venture capital investment that went into Pakistan was less than 1,000th of that factor. And if you, again, remove the border and consider that we came from a common base in some ways, a lot of the consumer behavior is very similar, and we might be earlier, and so there's an opportunity to both for technology to leapfrog, but also for learnings to be picked up from different ecosystems. But the supply-demand of venture financing in the country is completely off balance. And that is why the opportunity being a financier in the market and playing the role of VCs we see as having a great opportunity in the market. And that's really what underpins the key thesis behind setting up of this fund. And the segments that we broadly look at, or the two categories that we define it, are in a way can be looked at as a Pakistan for Pakistan and a Pakistan for the world opportunity. And the idea there is that we have a large consumer market, where GDP per capita might be low, but that therein lies the challenge for some of these startups to be able to make economics work, even with the kind of earnings that you have of each individual. But there's also another segment which is very interesting, and some companies have already leveraged, such as Kareem, such as Affinity, Deep Trucking, again, some names that might be familiar to people from North America, where you leverage the low-cost base in the country to have outward-facing products and opportunities as well. And again, as a reminder, Kareem's initial technology was built on Tariq Road in Karachi, and this. For now, following the acquisition by Uber, we have had some of those computer scientists sitting in Karachi become dollar millionaires. Never before in Pakistan has something like that happened. And what that does is it creates legions of the next entrepreneurs. Even within each one of these successful companies, 10 new founders are getting trained, and they are coming out and then creating their own new startups, which again, hopefully will also be successful, all within the same kind of probability stats that you might be used to in any other ecosystem. But what is good is now there is a lot of this happening, which 2 years ago was not the case. In fact, even just as early as last year, we did not have the number of funds that we have, the number of investors participating in the market, the number of startups, the kind of rounds that have been raised over the last year. And all of this is, in our minds, representative of this digitization wave that the country is going through. And now investors are coming to find those opportunities, which hopefully will continue. And maybe one thing I can add finally on this is, with COVID, all of this has seen a little bit of an acceleration rather than any sort of impediment for the ecosystem. And the reason for that is this entire digitization trend, where it was moving at a slower pace, now has accelerated because even people like us are now ordering our groceries online, we're ordering our medicine online. Businesses that did not have any digitization before are now getting digitized because they realize when situations like this coming up, they might not be prepared for that. Reliance on entirely brick and mortar and traditional means of business is not necessarily, in our minds, the way to go in this decade and beyond. And our call has been primarily that this decade will, inshallah, see Pakistan have not one, maybe even more unicorns. And if there is a role to be played in helping creation of that in a structured form, where we can also bring relevant expertise or bring people that have those relevant expertise into contact with those kind of businesses, there aren't really any building blocks that are missing. Of course, we can discuss how supportive the government is, or whether the infrastructure in Pakistan is already developed enough. But the reality is no ecosystem in the world came up and was perfect on day one. And what we do have is the opportunity to actually learn from a lot of these other ecosystems that have come up. Ourselves as well, we can apply some of those learnings on how funds have gone about at early stage. A lot of the entrepreneurs can again leapfrog technology. They can learn from Indonesia, which we use as a very relevant benchmark for some of the companies in Pakistan as well. All of that learning coming together and getting formalized in formal structures means that now there is actually a formal avenue for these entrepreneurs to also rely on. And that has been, again, the thesis with which we set up Sarmayacar. Currently on this first fund, the terms of which are displayed in front of you, but our hope and our work is built upon this becoming a long-standing early-stage investment platform. Where we continue to back these companies across hopefully even multiple funds down the line, and that we can play this role of being that local partner of choice, both for entrepreneurs, but also for international investors that speak our language. And that's really the bridge which we felt was missing previously, and to an extent is getting plugged partly by us and partly by a lot of other smart people that are also participating in the market and bring together expertise that can ultimately help these companies as well. So I'll just pause there because I realize I went on a little bit of a monologue. But Salman, I don't know if there's anything in particular that we should address. We haven't spoken too much about the team or the portfolio, but I'll just pause there in case there's any questions that we want to get into, or we can talk more about this.
Thank you, Rabeel. Thank you, Salman, for this this very well presented deck. Very encouraging for Pakistan and everything. There are lots of questions, some of them common, some of them different. So what I will do is some of the questions are related from entrepreneurs' perspectives, some are related from investors' perspective. So I'll start a few and mix and match a few things, and I think hopefully the discussion will take around its own course. What are the stats that you think are relevant for people to know from an investment perspective as well as startup perspective on some of these companies that either you have invested in or generally what you see across? For example, from start up seed round going into Series A or next round, what percentage of companies are becoming successful and what percentage of them are getting completely bankrupt or belly up? Or do you have any stats around that are useful to share from a investor's perspective and also from people who are doing startups?
Yeah, sure. So it's a little bit challenging to know, for example, how many new fresh startups are coming every year, coming up every year. But one rough estimate could be if you look at the number of incubators and accelerators in the country and how many they have per batch, and then our in general experience is that actually roughly only half of the companies even consider going through an incubator or a startup. And that estimate will get you anywhere from 500 to 1,000 startups coming up every year. This is prior to COVID. Of course, now it's going to be a little bit even tougher to make it work. However, out of those 1,000 startups, the failure rate is the same that you would expect in any other ecosystem. What we use as a couple of metrics or stats are really our failure rate of our portfolio, i.e. how many of the ones that have been invested in that are no longer active. And then one is a follow-on capital raising rate, meaning how many of those have gone on to raise follow-on rounds. And each of those rounds we assume to be a follow-on round if it's raised at a higher valuation and the quantum of capital that is being raised is more than the previous round. So if we talk through some of our existing companies, Bykia is a matter of days away, hopefully, from closing a Series B transaction. This would be the first of this fresh wave of Series B transactions. I cannot name the company or the investor that is doing the entirety of that round. In addition to Sarmayacar and another existing investor signing up to our pro rata share, But this one would result in the valuation of the company being north of $50 million, the capital amount itself being in 8 digits US dollars, and represents, again, in just from last year, Series A, actual advancement and progress. I can also give you a sense that the business, right before COVID, was roughly 5 times the size that it was at the time of our investment in Series A. We are now expecting that recovery to come back by August. In fact, in one of the cities, Islamabad, which was always Kareem's most important city, we are already back to 120% of our pre-COVID numbers. And this is like the first city that is kind of like, come back on. So the idea and the underlying traction of these businesses is quite strong. Of course, some of this is counteracted by FX devaluation, which gets ultimately reflected in valuation. But compared to where we entered, both on the underlying KPIs and the valuation, Bykia is now 3 times or so of that overall. The next company perhaps I can speak about is Davai, again, which at the end of last year, last day, in fact, was when we invested in Davai. Since then, there has been more investments, and they are also currently on the verge of potentially closing a 4 to 5 million Series A round as well, which again, already the valuation is more than 50% higher than where we invested before. And in COVID, Davai has set new monthly highs each month starting from March. So March was their highest month, and April was higher than March, May was higher than that, and then same with June and May. So underlying traction is positive. Demand side is actually not really too much of a problem for both of these businesses. It's in fact mostly on the supply or the logistics or supply chain, if you will. So to the extent these examples give a little bit of a sense of how these businesses are trending, that of course does not capture how the businesses that aren't successful and that are only surviving for a few months or might only be present in an incubator, and the moment they have to go out and can't raise funding, they fall through. There is a lot of that in Pakistan. I think we're not at a stage where every single company that is coming out is backable. We in fact have looked at over 500 situations, but have so far invested in 7. And so that also should give a little bit of a sense that the backable companies, which are led by these truly amazing entrepreneurs, and also have the right kind of technology base, the right market, and some capital to kind of start with. Very few of these situations line up, the ducks line up entirely for all of them. So in some cases, you will have to fix some of this as well. For example, one thing that we've looked at quite a lot and we unfortunately have to face is our restructuring of cap tables, where a small amount of money led to large dilution at a very early stage, which means that for any subsequent investor or particularly institutional investors to invest in those businesses, they need to see a little bit of right sizing of incentives, and particularly with the focus on founders continuing to retain the majority of the equity, or at least have enough skin in there that they can also make some wealth, or again, if it's a successful outcome, that they can also accumulate some wealth that way. I don't know if this answers your question, but I think
to a large extent, but I would be, interested also to know some failure stories along the way, because I think that you learn more from them than the successes.
Yeah, so I think failure stories, for example, again, I don't want to kind of comment on anyone else's business and whether it's a failure or not. Maybe we can talk about one of our own portfolio companies where we don't feel that it is going as we would have wanted. And this one is an education platform called Dot and Line. And what happened was during COVID, this company is an after-school tuition marketplace in Pakistan, which relied on home-based small academies being created at these teacher partners. And a few kids in the vicinity would come to that teacher's home or whatever premises, and they would effectively be kind of like, getting tuition around math and English. The challenge that came up with COVID is that was not feasible at all. And this business had to pivot, and they pivoted to an online offering, calling themselves .online. That pivot, unfortunately, is not yet getting the kind of traction that we think it could. Now, this could be a timing consideration. Again, it might be a little bit early in Pakistan. It is also, we believe, linked a little bit to how the dynamics of education work in Pakistan, i.e. Parents want these tuition places to also be making sure that the homework is done of the kids, etc. Not necessarily just tying it to like a learning outcome, but also in terms of the grades that they get in their normal school. So what these businesses find challenging to become is a school replacement opportunity. They can be like complementing what these schools offer, but the moment they're positioned as a school replacement opportunity, they don't have the same kind of like traction with this with parents. So if you ask us whether education or edtech more broadly is going to be one of the key areas that could be interesting in Pakistan, absolutely. Just because of the demographics you mentioned, like, just the inefficiency of like, some of the more traditional means of discarding that information. I think it's going to be a matter of time that Pakistan can also see something like a Byju's from India. However, we are not seeing in the market an opportunity that is kind of showing the kind of traction at this stage that Byju's had initially. And that might be linked to one of those factors that I mentioned, or even what are aspirational subjects in Pakistan and how does one go about digitizing that offering. So key difference between India and Pakistan is India has math and science as the aspirational subjects, whereas in Pakistan it's English. Because if you can speak English, then parents perceive your child to be like better educated, or better or for worse. So that's again one of the opportunities that we think is valid, but we have not yet seen a particular company really try to break it through. There are other segments where there were attempts, and we feel that it's not that exciting an opportunity, or where the economics are not very interesting. For example, generalized e-commerce in Pakistan is now a very tough battle against Daraz, and Daraz again had to spend extra at the beginning, had to both create that category, create awareness amongst people what e-commerce is, solve a lot of these logistical challenges. But because of a lot of that, burn that they've had, which was again getting people used to discounting and whatnot, any new player that is entering space has to have either a lot of capital already lined up, or needs to have a very unique proposition in the market that will allow them to compete with like a Daraz. And I think that's where we again have not seen opportunities come up that can really claim to be competing with them. However, different pockets of opportunity come up within that entire supply chain, or even the fulfillment chain. And so we are yet to see even a startup per space that has opened up. We have still not seen anything in fintech that can really claim to have solved many of the challenges of the market. The only thing that maybe has been somewhat solved is domestic remittance through EasyPesa or JazzCash. But beyond that, we still don't have an offering that makes it easy to collect digital payments, to not have these 2-week cycles of cash on delivery. But then companies also need a cash on delivery solution, which should be more efficient than what a TCS or one of the traditional courier companies in Pakistan can offer. So a lot of these spaces are, while still white space, and we believe that they will get occupied, but there's not a backable company in each of these spaces. So to the extent you want to take that as a failure or as still something which is not yet happening across the board, I think that is something that one has to do.
That's very useful, Rabeel. Thank you for that. I think at that last point, especially on some of the e-commerce challenges and some of the fintech challenges, I'm sure this is of interest to many participants here. A couple of things from an investor perspective, because you presented one of the slides from a fund perspective, then we'll go back to more generalized questions on the startup perspective as well. So right now, your target fund size is about $30 million, and I believe most of it is raised in the investment structure as it is. It's a Netherlands domiciled US dollar fund. Now, looking at the target returns, you mentioning around or greater than target of 5 times with a pretty hefty, obviously, management fee and performance fee. Now, my question around that is, from an investor's perspective, given it's a 10-year lock-in period, how do you see challenges from your perspective, not just your perspective, but any VC obviously would have similar types of structure, whatever they do, is investing from, let's say, an overseas Pakistani or overseas investor or any investor is a function of 3 things, which is the returns, the risk, and the liquidity. In this case, any VC, obviously the liquidity is a challenge because you have to lock up, otherwise what's the point, and you can't really add value. The risks are there, as we all know, because the longer the duration, the whole game of your VC structure as well as any other early stage is a high risk proposition. Now, if we look at the returns, let's say generating 5 times or more than that, and then we look at an average VC return, not in Pakistan because the data is not yet there, but across the world, they tend to be median is negative. Now, considering that means the standard deviation around those VC returns is very high, considering that the liquidity is very high, considering that it is Pakistan and 10-year political cycle can have a lot of problems, the annualized return after taking the cost I just calculated turn out to be about 14.5% annualized if we do 5 times. Now, if I'm investing in dollars, what incentive do I have versus putting my money passively in S&P to get 10.8% annualized total return around?
Very good question.
It is a challenge, right?
Very good question.
How do you or any other VC addresses that?
Yeah, so a few considerations. So when you look at the mean returns of an average fund in Silicon Valley, there's a different kind of problem that they have over there. It's a problem of requiring mega exits because of this large size of their funds. So in fact, what we haven't done is we haven't yet closed on more capital than we think is also deployable, because we wanted to actually make the structure be a function of the opportunity rather than already set up a certain fund and have this idea and then not find the opportunities to actually invest. But why do we believe that actually the returns that can be generated in Pakistan can outstrip some of the returns other asset classes will offer you, adjusted for risk? If you look at, just to address the FX rate, if you look at the long-term FX trend of Pak rupee versus US dollars, it actually over a longer period averages out to below double-digit numbers, which even when you add that onto what are the PKR returns that you would be expected to generate, we think that actually returns of 25% north IRR are very much possible. And in fact, how we price each one of these transactions is on a 25% plus USD basis, IRR basis. And the lockup period that is mentioned is not tied to no funds flowing back to investors prior to that. In fact, we are under the Dutch small fund manager requirements, and also according to our fund documentation, are obligated to pay out any proceeds received either from dividends or from sale of companies within 60 days to our investors. So the calculation, if you have to do to calculate the IRR, it would not be at the end of the 10-year period that you would see the first return. And commensurately, actually, the actual drawdown is not on day one. So if like based on where our portfolio is currently marked, based on let's using our one like the World Bank or the IFC who are investors in our fund, their timing of payment, they're over 70% IRR right now. And so when you compare that across in this time period, other asset classes, we think the venture opportunity in Pakistan will far outstrip the returns. Now, when you think about the risk that is involved in there, the entire setup that we've had is to mitigate some of those risks and to also try to de-risk the companies so that we don't expose all the dollars that we want to have exposure in a particular company on day one. So we first also, as part of particular rounds where we do have typically we do have some tranching, which we don't link it to some sort of crazy milestones that they can never reach, but just to instill some discipline based on the plan that the companies themselves share. We are able to then ascertain what is the cash requirement so that we can, at least from a cash perspective, de-risk it a little bit. And then, of course, from our own exposure perspective, it gets de-risked because our subsequent investments will only come in performing companies, which are then being, the rounds of which are being led by external parties and then at a higher valuation, et cetera, so on. All of this, we believe, is how other VC funds or other ecosystems have seen progress of their overall kind of ecosystem. And right now, I believe that we are only approaching the Series B stages of these companies. And the exits aren't going to all of a sudden start at the Series B stage. It's we're going to go hopefully following on to Series Cs and whatever might be required. But there's a couple of underlying assumptions which drive our view that lesser capital might be required to break even on a like-for-like basis for a company in Pakistan versus other parts, because again, it's cheaper. It again requires a lot of focus on unit economics from day one. You cannot bank on availability of financing being there all the time. So the focus that every team needs to have is on building a business that can get to profitability very quickly and can take on as little capital as possible. So when you take on lesser capital, and we as a fund are also smaller, then actually even smaller exits can become very interesting, which brings me to the last kind of point, which is around liquidity. Our view is not that these companies are going to now all of a sudden start listing in Pakistan or other markets. In fact, it might not even be very attractive to list one of these businesses in Pakistan, other than maybe like a Dubai, which can also have some brick and mortar pharmacies and be the largest mover of pharma in the country. Most of these other businesses, in our view, are going to be the most likely source of exit is an acquisition by a foreign player as a means of market entry. And why we think that thesis holds merit is because localization requirements are so strong in Pakistan that even when you start from scratch, a foreign player versus a local player, and you're spending both the same amount of money and same time, the locally set up player is going to do better just by virtue of understanding the market better. And what that means is that for these international players, acquiring one of these businesses and then building on top of that is actually, in our mind, going to be easier. The best example I can give of that is Uber and Careem. Careem was localizing a lot more effectively than Uber, and it resulted in Uber having to pay quite a hefty price for acquisition of Careem. Even at the time of acquisition, Pakistan was the second most important country for Careem by rights or by value, however you want to ascribe it. And that value, even if you ascribe only $500 million out of Careem's overall valuation to be ascribed to Pakistan, that was something that Uber had to pay after spending $250 million of its own. And not being able to get to the kind of market share that they would have wanted to. And now both Uber and Careem, for example, in the bike category are trailing Bykia. which is an even more localized one because it has its driver app in Urdu. And the segment that you're targeting, motorbike riders, they understand Urdu a lot better than English. They can't type in English. They can't even search addresses in that way. So a lot of that focus, which again, to the people that don't know, Bykia is led by Munib Meyer, who was CEO of the RAS. So that original understanding of the problem came out of the fulfillment for the RAS. And then leveraging the 22 million motorbikes in the country, like, the smartphones that Salman mentioned, these are existing assets that just had to be leveraged in a way, utilized better, and with an extreme focus on localization and solving the problem of how to get these drivers to earning $2 an hour versus the $1 an hour that they can earn right now. Now, as you can imagine, like Uber CEO or even like, Mudassir as Kareem CEO, just the bike segment in Pakistan was not a big enough problem that could take up all of their attention. And what that creates is it creates opportunity for businesses like Bykia, which are completely localized, are effectively positioned, and now offer an acquisition opportunity for the likes of Gojek, Didi, Grab, again, all these businesses are not present in Pakistan and are looking at new growth avenues for them to also grow. So that's really our key thesis around exits. And as soon as those exits come through, the structure of the fund is set up that we pass on all the proceeds to our investors so that we can keep recycling through future funds as well, some of that capital. And our view is that 25% IRR USD is very much achievable. And I think when you take that view, I think there's going to be few asset classes. In fact, even within venture, I think there's going to be few other ecosystems where you can still expect that kind of return to be generated for a seed fund. Again, if this was 15 years ago in India, it might have made sense to look at a seed fund. Now, it doesn't make as much sense because now, you're going after vertical position number 4, 5, 6. Like vertical leaders are established. In Pakistan, other than the RAS in e-commerce or maybe Zameen in prop tech, no vertical leader is established that you can't effectively back them. And once a vertical leader is there, I think the fact that they will hit $100 million or $500 million valuations is not beyond the realm of possibilities. Certainly not.
Thank you. That's very comprehensive.
I just want to add one thing to this, Hammad. I think this also touches upon the earlier question you shared. So one of the things, of course, in that presentation or the deck, the IRR that you're calculating, 15%, might be somewhat higher or somewhat lower than S&P returns. We can obviously argue for that, but that's also the base assumption of what successful VC funds in emerging markets have generally returned to their investors. The view that we do share internally, and obviously we still need to prove it out, especially in the Pakistani market as well, is where we think the opportunity is, and similar to what Rabeel is sharing, the opportunity is massive. This is a market north of 250 billion that's looking to get disrupted from offline to online. We also in the local ecosystem currently don't have consolidation in standard brick and mortar businesses. We believe that simply consolidation of that businesses via tech is only going to increase the ability of these businesses to grow in size and provide very attractive returns to investors. The one last element which I want to touch upon regarding the question of whether there have been failures in the tech space in Pakistan and what have they been. It's perhaps also, I guess, clear and apparent is that there haven't been massive failures because there's still a lack of competition in the ecosystem. As we famously have heard tech investors abroad claim competition is for losers. Unfortunately, that lack of competition means that some of the companies that haven't quite scaled or haven't quite gained traction continue to exist because they're ahead of competition that's maybe still figuring it out or simply not having any competition again. So they're again able to go out there, raise some capital or pivot their businesses because of the advantages that the cost structure does have. So once again, it's coming what we think is very exciting time in Pakistan, simply from the perspective of timing and also the market opportunity, where with us seeing more and more businesses gaining traction on a month-over-month basis.
Thank you very much for this answer. Just for the interest of the audience, if Rabeel and Salman, you are not pressed for time, we may run over a little bit. So because there might be more questions around these things. So a few things, I think, as a conclusion to this, I think from my perspective, I would summarize your answers to also mention that the bottleneck seems to be also from an exit perspective, lack of listing opportunities versus the US. So it's mostly acquisition opportunities, which you think in your thesis is that there would be a plenty because of growth on emerging markets and bets of these companies to acquire. That does present a little bit of a bottleneck, but I think we can hopefully address that next time. I want to ask a few questions from a startup perspective as well. There are a lot of interest on very young, talented startup founders coming straight out of university. Now, what we have seen, at least from an outsider's eye, seems to be most of the money goes to people who have either done something before, so you can read into what they can do, I guess. Bykia is an example, as you mentioned, or people who have had some kind of an experience in some market where you can read into what they can generally do. What about the people who are really starting up and they have a great idea and huge commitment and so forth? Where do they go? How easy it is for them to raise?
Yeah, I think overall, there's just more capital that is getting invested. And what that means is there's more formally structured venture capital activity, but there's also more angels, which off the back of some of this entry of the formal funds are now also willing to write some of these like sub 100K checks or sub $50,000 checks. And so what we're seeing is like quite a variety in the types of startups that come through. And there's a certain kind of like, batch which goes through these incubators and accelerators. And as much as like, I want to kind of encourage every sort of business or every entrepreneur in the country, we don't see that necessarily incubators and accelerators are rightly aligned with some of these businesses, because the businesses or entrepreneurs take this as an opportunity to get like, some free space, free internet, etc., test out something, whether it gets any sort of traction or not. And what we're looking at is like, again, the stage which is beyond that. So now, given the checks that our fund is writing, we almost expect each of these businesses to have gone out and tried to explore where they would put together an angel round or a pre-seed round. And now you also have other funds that would do, for example, pre-seed investments. So overall, there's just more capital. And of course, we will continue to see this more capital even in the wake of COVID, but it might be focused on fewer names. Where some of these other entrepreneurs can go is, again, the same avenues that are possible for any new entrepreneur in another ecosystem. You have your own, either you bootstrap it or have like some friends and family around. You have some of these fund like grant providers, which again, like, also exist in Pakistan, like the Gates Foundation or through Karandas, etc. Then you have, of course, angels that might be writing slightly larger checks. These angels might be either associated to large businesses in Pakistan, where they might be taking these stakes individually, or in some cases also through the business. Then there could be a pre-seed fund. Then once you raise from a formal fund, other regional funds start looking at those opportunities, such as the Middle Eastern ones. We're also seeing the Far Eastern ones now start to invest. And if within that investor base, one or more investors speak for additional rounds, you then get onto this ecosystem, this venture continuum, venture financing continuum. One example I can perhaps give is Airlift, which just to be fully kind of clear, we're not investors in, but they initially raised like angel capital, then Atif's fund Indus Valley participated together with Fatma Gobi, then a Silicon Valley fund, etc., came in the Series A. And then again, they have another couple of new investors as part of the Series A extension. So it's not just the same profile of businesses, but those Series A or those Silicon Valley funds would have never invested in that unless the earlier stage investing had been done by those angels or some of those pre-seed funds. And that's what we expect for there to be broadly for most of the businesses. At some point, we also can expect strategic interest to come from different partners. And one such was, in fact, Gojek wanting to invest in Bykia as part of already the Series A. Again, the view was taken at that point that it was not such a strategic investment at that point, and also looking at how Gojek's investment in Patao had panned out, which is the Bangladeshi equivalent of Bykia. These are all views which have to be taken into account at a particular time for startup, given the interest that is there from various different investors. But we are seeing overall a great increase in that kind of like interest. One final thing I also want to mention. Part of the setup of our fund was also done with the view that if we could get institutional or larger investors as LPs, then they could also write some of the larger checks. And we're already seeing that with IFC. In fact, we've seen a check of theirs be turned down. And this was, again, a $5 million check into one of the companies because there wasn't enough allocation. Now, the view is, and we know this from what has been communicated to us also very clearly, IFC don't want to be doing seed stage investments in Pakistan. It's just too much work versus too small a check and requiring a local setup, a local team. So the fact that they backed us is because we can then create a little bit of a curated funnel for them to then pick and choose which companies they might even want to take exposure to directly. And because even one of those investments can trump the entire investment that they've made into our fund, that solves their purpose as well, that ultimately if one is taking a view on Pakistan for the next decade and you want to get these partners with eyes and ears on the ground, this is the way that we set up the fund for, and that's what they have also bought into. And IFC is just one example which I'm quoting, but we have within our base actually a few LPs that are in a similar position where they can take a larger stake down the line directly. And I think that is just a view of either setting up a full VC operation within your firm or backing a fund to do the groundwork, and then at the right stage when these companies are getting a little bit de-risked, then they can participate and take direct stakes as well.
Right. In terms of talent, do you think there is a constraint on as companies grow, especially on a senior talent? There is a founder, there might be a co-founder, there might be multiple co-founders, but from that point onwards, when companies grow, and if the ecosystem grows and becomes bigger, is there a dearth of talent? For example, looking at India, which most people look at for comparison, it took them years to actually start attracting talent from outside of their own country, expats coming back. Do you see that happening at the moment, or that's one thing? And another thing is obviously, if there's a dearth of talent on that level who can take the company forward from an executive perspective.
Again, excellent questions. I think there is a dearth of talent, but there is a lot of resource. And the reason I separate the two is that resource hasn't been exposed. And that exposure comes from either building companies or investing in particular spaces. And for a bunch of different reasons, Pakistan didn't benefit from the return of the successful diaspora like India did, or Indonesia did, or Nigeria did. We're starting to see some of that trickle effect happen for two reasons. One is both a pull factor because of Pakistan. People are seeing more activity there, and there is, of course, there's always this, apnayat, if you will. The easiest way for me to describe it, in your own country. There's a little bit of a push factor, i.e. the rosiness of the opportunity that have historically been driving the decision to stay there might not be as rosy, so people are considering it. However, this does not yet fully make up the gap for the entire, let's say, the first rung and the second rung of management that you have in these startups. What you are getting is, though, are you getting specific people that have been exposed that will then try to bring on a couple more people that are then working on training the next layer. And where there are gaps, players like us will bring executive coaches, like, actual trainers, even involve individuals that might be familiar with that particular space. Because a lot of times it's just about, again, being a platform that can connect the right folks. So we're not there yet. And certainly it will, again, given how India has fared over the last decade and a half, we are much, much earlier in that kind of process. But the direction of travel is certainly the right one. And if I can hint at some of these Pakistanis that have been coming back, these are again, really the last couple year phenomena. Before that, it was, again, more people choosing to stay abroad. Now, whether this was driven by the Naya Pakistan promise under Imran Khan or just a realization that the world is also moving a little bit, or that growth in Pakistan was attractive at that point. What we know is that globally, in terms of these platforms or these freelance platforms, Pakistan is typically top 4. It's US, China, India, and Pakistan. In terms of resource, or in terms of people that are taking up this line of work. But they haven't, like I said, been groomed or trained or exposed to investors to go out and be the full, all fully rounded entrepreneur. Even some of the people we back, they might be very good in particular aspects, but might be actually quite weak in aspects like fundraising. But then those are the gaps that can be plugged. And the more investors that you have on board over time, the more expertise and perspectives you also can benefit from. And that's how we see this overall progress of talent development being actually quite fast, but starting off of a low base.
Thank you. I think a bit of a blunt question, if you don't mind, which is from a successful startup perspective, given that most current VCs in Pakistan, not just you, it's not just for you, but all VCs in Pakistan are relatively newer, I would say. So they themselves are a startup in some sense.
Yeah.
So from a startup perspective, why should they partner with one, or let's say you, in comparison to another? What one brings versus another? What should they look at?
I think that's a very fair question, and I don't think there's one size-fits-all answer to anyone. I think what we bring, for example, our view was that we need this infrastructure and team to be able to provide support and really substantiate this whole value add component, because we don't think by just writing a check, it's enough to get these companies to then do wonders and or figure out themselves where the next round is being raised and then exit these companies, etc. So it required a certain kind of focus on who are the people we can help, where we can actually help, and that is gets baked into even our investment decisions. Now, one question which is asked often is, private equity hasn't worked in Pakistan or hasn't been successful, so why should venture? And I think one of the key differences there is the very nature of a business which makes it attractive to private equity is cash generative and stable businesses with some growth, but by and large, things that are not moving too much and have a risk of falling off a cliff. Those businesses are, for the most part, owned by families in Pakistan. These family-owned businesses, when you wear a shiny suit and go to them and say, hey, we're going to come in, we're going to shake things up, we're going to get rid of one division, we're going to add some people here. The response from most of these family businesses is okay, maybe from the next job you can do that. I'm happy with my 50 crore of free cash flow that I'm getting. You might take it to 70 crore, but then it's not my business and so on. When you compare that to a young entrepreneur, that young entrepreneur actually knows they need help in many of these aspects. And that whether or not they get it or not is also key input in terms of us figuring out whether an entrepreneur is backable or not. And so what you have is a starting point where some of these entrepreneurs recognize that they need help and support in various functions, such as, again, raising capital, in hiring, in being able to make kind of strategic kind of like calls. Is in fact that if capital is the only value add anyone is looking for, we might not be the best partners. And so what that does is, in that process, it also helps us understand where we can make a difference and where there is alignment that creates for a possibility for us to invest. So that's how we have been, again, approaching this. I don't know if, Salman, you have anything to add on this?
Yeah, I think one other thing that I also want to add on this is our investment approach. Our investment approach is also a conviction investment thesis, which implies we are not necessarily just spraying checks all over the board. We're having a concentrated view on companies where we want to take a stake with a founder who we do want to back and who we do think we can contribute value in terms of both feedback from GPs, free feedback from the team, and even getting our hands dirty in a lot of what I would consider strategic or capital allocation decisions. These are views that we think help shape the business for success over a longer term, and are also being mindful of a lot of fundraising elements where we want to be able to speak some of the language which would attract foreign investors or foreign VCs to understand that the local VC setup in Pakistan has the same aspirations of building large businesses that have valuable exit opportunities outside and not necessarily become dividend plays in Pakistan.
Maybe if I may add, I understand we've spent time on this question, but there's also various different avenues to which again, this value addition or how this kind of partnership approach is taken. Last year we did our first annual summit where we took our portfolio leaders to Hunza, and we brought a team of executive coaches from London. We brought our investors together. Since then, two of the companies have gone through formal programs with these executive coaches and team coaches to work on simple things like culture, mission, vision. How do you hire according to that? Do you know the key skills of the team that is around a founder? What are the gaps? How can one plug it? And just to, again, give one actual evidence or example, Munib, who's the CEO of Bykia, is going through both one-to-one coaching with this executive coach. This executive coach has been a coach of Fortune 500 CEOs, continues to be. In fact, one of our anchor investors is the one who's also covering $50,000 per year coaching for each one of these portfolio CEOs. This is all coming out of pocket from one of our LPs, and that LP is not Pakistani. His view is, again, that a lot of these entrepreneurs can go on and plug the gaps that they might have at the beginning, but absent a platform like this where they can get in touch with the right people, learn from them, and maybe in some cases also get a little bit of financial help in making that happen because the startup itself might not be able to afford it. We want to look at all of that together and try to help businesses as much as we can. And that's why we're extremely selective in which businesses we get involved with. But literally, once we're involved, the definition is roll up your sleeves and try to see where we can help and everywhere we can help. And that will, of course, requires infrastructure, it requires capital, it requires access to other investors. And so far, we think it's been working well.
Thank you. I think there are a lot more questions, but unfortunately, we've already run out of time. So for many people, that could be a little bit of a problem. Maybe we can have another follow-up session. But I think in order to just have a proper finish, I would ask either of you gentlemen maybe to summarize what this particular forum or fora such as this could achieve for VCs like you as well as startups, and what can this forum bring to the table?
Salman, you want to go for it?
Sure. I've had a little bit more interaction with Ali, so happy to share what we think is valuable from our perspective. My understanding is that there's a lot of course, talented diaspora abroad that can potentially look at Pakistan in terms of both mentorship opportunities or maybe even potentially setting up a business of their own. I think that that's an avenue that we want to facilitate, and if there is a role that we can play at that, we want to be, of course, be available to those individuals. On the second front, we understand that the Pakistani diaspora is also starting to understand some of the opportunity that exists in the ecosystem. And if there's any opportunity or any consideration for individuals to invest via our fund directly, being an LP in the fund, or potentially even participation specifically in startups that might not necessarily be part of our portfolio, we want to help play a positive role in creating a bridge between the diaspora Pakistani and the local ecosystem, as we think that there's a lot of opportunities of win-win relationships, be it through individuals, be it through Sarmayacar itself, or for talent to get attracted and really think of it as a serious step in terms of coming back home and starting a venture of their own.
The only thing I would add to that is also facilitating some of that flow of talent towards the portfolio companies, beyond just a mentorship consideration. So one example I can give is like, this is a company which hasn't even launched full operations, is only going to start pilot operations. It's in the payment space. Again, to be candid, not one of our portfolio companies, but they've been able to attract a CTO from Gojek. Which again was 5 years ago or even 2 years ago, might never have considered even Pakistan as an option. Similarly, even rigor that one of those places instills in you. So a platform like this is great to also identify those opportunities, because a lot of these people might know them, or some of these people might themselves be interested in considering one of those opportunities. So we think that anything that creates a little bit of a formalized link with us requires us then to report our portfolio performance to those LPs, to kind of like feedback to them how different businesses are doing, etc. And that just creates this kind of like, channel and a little bit of a more structured avenue through which involvement can then be explored through more kind of like, across many different avenues. For example, we don't ask any LP to promise us X number of hours because we're going to spread those across our portfolio. No, what we want though is like, if a particular LP is very well suited to even one company, we might even request them to take on the board position that Sarmayacar gets. Again, the idea being that they might be much better positioned than any of the team members within Sarmayacar to actually add value. But because incentives are aligned in that investment is being routed through Sarmayacar, and this is the right that Sarmayacar has in every investment, we get board right, we have these reserve matters, etc., that are again non-negotiable. But we're not fixated on believing that we know the best of every business model or best of every situation. We're again trying to be these bridge builders, and we're trying to put together these rounds, these kind of like, the cap tables, the way the international community also can recognize, while managing the risks that are involved on the ground by us being there and doing that, rather than requiring each one of those LPs to either have set up their own setup in Pakistan, hire a team, or to continue to do this on a fly-in basis, which we think neither of them are really sustainable or even efficient in that way. If the objective is to both help Pakistan, get exposure to the Pakistani tech landscape, try to play a role selectively where there might be more interest in particular companies, all of that we feel can be achieved through a fund like ours, and while not compromising on any of the other options. So that's really to sum up effectively.
Thank you very much, gentlemen. So if anybody in the forum is interested in any of these things, I would encourage them to get in touch with Adi to get connected to either Rabeel or Salman. Very hopefully informative session for everyone, at least for me. So thank you, everyone. We ran over. Thanks for your time. There are some of the questions still left, but I apologize for that. That's always going to be the case in such short sessions. But thank you, everyone. Thanks.
Excellent. I just wanted to mention, because I think I was seeing people say what would be next steps. Feel free to again share our emails. You can get in touch if anyone wants information about the fund, about any of the companies. Happy to share that. Just to mention here, my email is Rabeel@Sarmayacar. That's RABEEL, and then we have Salman@Sarmayacar.com.
So super easy as well. To please feel free to get in touch. And thanks for everyone for tuning in. Hammad, thank you very much for moderating this session. And of course, Ali, great job in setting everything up. Appreciate it, guys.
Thanks everyone for the time.
Great, thank you.